Hey guys, welcome back to the channel. In today's video, we are going to discuss exactly what is going on in the Australian property market. Let's start with some facts. 1. We are in one of the worst recessions in Australian history. 2. The current unemployment rate is at 6.9%, and as most of you guys would know, that number will be much higher without the JobKeeper scheme. And finally, in the month of October, all of Australia's property markets, with the exception of Melbourne, saw a monthly increase in the property values. We're not talking about a small increase. If we look at the graph here, Adelaide, Hobart, Darwin and Canberra all saw an increase of 1% or more. To put things into perspective, based on the national median value of $559,000, that 1% increase is an increase of more than $5,500 in 31 days. Or in other words, around $177 per day. So we have to ask ourselves, what the hell is going on? With so many businesses closing down for good and so many people losing their jobs, why on earth is the property market going up? And where is that 30 to 40% correction that a lot of experts were predicting in March when all of this first started? So let's take a deep dive into exactly what is going on in the Australian property market and what 2021 might mean for first home buyers, homeowners, investors, and renters. Just quickly, these videos do take a very long time to prepare, research, film, and edit. So if you find value in this video, please do me a huge favor by smashing that like button and sharing this video with a friend so you can reach more people for the YouTube algorithm. And don't forget to subscribe to the channel for more wealth creation and real estate content. So without further ado, let's get straight into it. Let's start by talking about the Australian economy. Obviously, the economies around the world are doing it pretty tough right now. This virus has hit some countries pretty hard and it has some pretty devastating consequences. Despite how well the outbreak was managed in Australia and how well we are doing right now, most states in Australia still went into extensive lockdowns, and this has caused some pretty devastating consequences, especially for Melbourne. Despite how well the outbreak was managed in Australia and how well we are doing right now, many states of Australia still went into very extensive lockdowns, with Melbourne being one of the worst hit states, which went into one of the world's longest lockdowns, causing huge economic and financial damages. Even though Melbourne is now out of lockdown and South Australia has now contained the cluster, this ongoing battle with coronavirus provides a lot of uncertainties in the future of the Australian economy. And due to all of this uncertainty, it will make a lot of sense for house prices to fall. However, as mentioned previously, and according to this graph provided by CoreLogic, house prices have actually done the exact opposite. And this is old news because many parts of Australia saw significant growth throughout 2020. Markets like Hobart and Canberra were barely affected by the coronavirus. In fact, they kept growing throughout 2020 to reach new heights and become Australia's best performers. Clearly, there are some factors at work that is driving up house prices in Australia. So let's take a look into these factors. The first and most obvious reason is interest rates. When the pandemic first started in March, the cash rate was at 0.75%, which was already at a record low. And since then, the RBA has aggressively dropped the rates on numerous occasions, including the latest drop on the 3rd of November, which saw rates drop to practically zero, from 0.25% to 0.1%. Another important takeaway from this rate drop is the media release statement, which states that the RBA will commence a $100 billion bond purchase program with the ultimate goal to support the economy through normal transition mechanisms of monetary policy, including lowering borrowing costs and lower exchange rates than otherwise, and higher asset prices. Some of the language used in this statement is very strong, including this statement: the bank remains prepared to purchase bonds in whatever quantity is required to achieve the 3-year yield target. And there we go, guys. The Reserve Bank of Australia have come out and said it themselves. They want higher asset prices and they are prepared to do whatever it takes to get those higher prices. This means higher prices for real estate and higher stock prices. For those that haven't watched my previous videos and don't know what quantitative easing is, this is pretty much it. the RBA is going to keep buying bonds from the government to create money that the government can use to further stimulate and inflate asset prices. The lowering of interest rates to record lows and the introduction of quantitative easing goes a long way in explaining exactly what is happening in the Australian property market and why the house prices in Australia have been so resilient despite everything that is going on. Now that we have looked at the monetary policies introduced by the Reserve Bank of Australia to protect the property market, now let's look at what the state and federal governments are doing to protect the Great Australian Dream, or as it may now seem, the Great Australian Bubble. Guys, if you haven't watched any of my previous videos, I will strongly encourage you to do so. In my previous videos, I go into a lot of detail about what the governments are doing and all the interventions that have been brought to the market to protect the Australian property market. In fact, I was one of the only few people who didn't believe the Australian property market would crash when all of this first started. So when all of this first started in March, the big four banks and a lot of property experts were predicting massive crashes and massive corrections in the housing market. Some were predicting even 30 to 40% correction. All of these people provided very good discussion points on why the property market will crash. They mentioned a lot about unemployment, business closures, and the overpriced nature of Australia's biggest markets. However, they overlooked one very important factor, and that is how important the Australian property market is to the Australian economy. A collapse of the Australian property market will mean a collapse in Australia itself. It will also mean massive unemployment in a lot of business sectors that is directly or indirectly related to real estate. It will also mean a massive drop in Australian wealth, because a lot of wealth in Australia is tied up in real estate. And for this reason, the Reserve Bank of Australia, the state government and the federal governments cannot let this happen. And I personally think they will do everything they can to prevent this from happening and to keep the property market afloat. With all of Australia now out of lockdown, our incredibly low case numbers, and the fact that we're now heading into the holiday season and people are actually out there spending their money, it will suggest that we are now on the road to recovery. While the economic consequences are somewhat covered up by all the government stimulus programs such as the JobKeeper and the promise of future government support and stimulus like the JobMaker program, many Australians are now putting this pandemic behind them and moving on with their lives. Despite some negative headlines on the future of the Australian economy, what we do know is that the property market has been very resilient during this whole crisis. And this was the same case back in 2018 and 1999. Both recessions, the property market did extremely well. And if we're looking at all this historical data and historical trends, the Australian property market tends to be very resilient during these economic shocks. And after these economic shocks, they tend to go on a massive bull run, meaning that prices are likely to go on a massive bull run when all of this is put behind us. An important thing to note here is that during the 1990s recession and the 2008 global financial crisis, the interest rate were very high at the start of those economic shocks, and the government and the RBA had a lot of wiggle room to lower the rates to further stimulate the economy and the property markets. However, this is not the case this time around. With the interest rate already at record lows, the RBA is running out of room to move rates to further stimulate the economy and the property market. So if things do get worse, it could be very problematic. They are seeing an increased number of daily cases and being hit very hard by a third wave and have been forced to go back into lockdown. And I personally don't think it's impossible for that to happen to us. If we were to be hit hard by a third wave, the RBA and the government will have to further stimulate the economy. And the question now becomes, would it be possible for them to do so with interest rate already at 0.1%? To accurately answer this question, we need to look at what else the RBA and the government are planning. There are two very important factors that could see changes in 2021. The first one is the responsible lending laws imposed by the Royal Commission after the 2017 Royal Commission review. The government is currently in the process of scrapping those laws with the ultimate goal to increase the flow of loans into our economy. While it is very important for businesses to get access to easier credit during the current economic crisis, we all know that if these lending criteria are loosened, it will likely lead to an increase in mortgages and more borrowing capacity for most borrowers. This will allow people to borrow more money, make higher offers on property, or even buy a second or third investment property, and this will ultimately drive up property prices in Australia. Will the axing of responsible lending laws be good for the Australian economy long term? I personally don't know, but what we do know is that if these laws are scrapped, we are likely to see higher house prices in Australia. The second factor that is very important to the Australian property market and will likely see changes in 2021 is stamp duty. The New South Wales governor recently announced that they are moving to remove this very inefficient stamp duty tax. And I think this is a great idea. This will give property owners and property buyers much more flexibility. However, this increased flexibility also comes at a cost. So instead of paying a lump sum in the form of stamp duty, property owners will now be paying a yearly fee, which increases the outgoings of that property every single year. And secondly, this is likely to also drive up property prices because first home buyers will now be putting that stamp duty money that has saved up into purchasing the property and making higher offers. And ultimately, this will put money into the pockets of homeowners. A good example of this would be someone who's looking to purchase a property in Sydney who initially had a budget of $800,000, but with the removal of stamp duty, they will now have an extra $30,000 that they can put towards a property, meaning that the budget has increased from $800,000 to $830,000. With New South Wales leading the way, it is likely that the other states will follow suit and start to remove this very inefficient and outdated tax. As a matter of fact, at the time of making this video, the Victorian government actually announced a $6 billion plan to reignite the Victorian property market. Under the new plan, new builds under $1 million will receive a 50% discount on stamp duty up to $27,500, or a 25% saving of up to $13,750 for an existing property. This shows just how serious the governments are about keeping the property markets healthy. While both the axing of responsible lending practices and the removal of stamp duty is not set in concrete, but I personally think the chances of this happening and following through is very, very high, as the RBA and the governments do whatever they can to further stimulate the economy without going into negative interest rates. But with all of this said, I look at negative interest rates not as an impossibility, but as an unlikely scenario. And in the event that things do get bad, the Reserve Bank of Australia will have no choice but to use negative interest rates. Now that we have discussed why the property market has been so resilient in the last few months, let's talk about where the property market is headed for the rest of 2020 and into 2021. Obviously, the data is showing growth in most parts of Australia, and the only state that is really struggling right now is Victoria because of Melbourne. However, with the recent announcement by the Victorian government, it is likely that we will see growth in all of Australia in the next few months. And I think this because of a number of different underlying factors and not because of what the media is telling us. Guys, I can't emphasize enough on how important it is to do your own research and due diligence. You could read 10 different articles or speak to 10 different experts and they'll give you 10 different opinions. So what we need to do is to do our own research and dig deeper into what is actually going on. There are a few very important factors that could suggest growth in the property market going forward. So let's take a look into those. The first factor is regarding the bank repayment holidays. I think this program was a great success and it prevented a lot of foreclosures and forced sales when the property market was at its most vulnerable. When this program was first offered by the banks, around 900,000 Australians took up this offer. The bad news is that around 145,000 Australians are still on this program. But the good news is that since this program started, around 80% of Aussies have already started repaying their loans. And the banks are predicting that number to drop even further in the coming months. This is very promising. It means that by the time the deadline comes, most of Australians will have already started repaying their mortgages, meaning that we are very unlikely to see a high number of foreclosures or forced sales. Another important factor to look at is consumer confidence. When the average consumer is confident about the future and optimistic about what is going to happen in the future, they are more likely to make bigger purchases, such as real estate. There is without a doubt that the strong consumer confidence will lead to a stronger property market. So let's take a look at where the consumer confidence currently sits. If we look at this graph here, the consumer confidence has skyrocketed in the last few months. And this next part might shock a lot of you, but the consumer confidence in Australia is currently at a 2-year high. And this is because of all the government stimulus programs, the 2021 budget, and the increase in asset prices like real estate and stock markets. Because when people see their investments and see their homes go up in value, they feel more wealthy and they are more likely to spend money when they feel wealthy. This in turn will increase consumer confidence. Alright guys, I know this has been a very long video, but I do like to go into a lot of details when I make these analysis videos, so you guys can see exactly where I'm coming from and why I think a certain way and why I'm so bullish on property in the coming years. Based on all the factors that we mentioned above, the record low interest rates, high consumer confidence, the government's love for property, how dependent we are on it, also the simple fact that Australians just love to buy property, as well as other factors that will come into play in the coming months, such as tax reform and the possibility of a change in lending practices, as well as the RBA coming out and saying they want higher asset prices. All these factors point to a very strong property market for the rest of 2020 into 2021. And to give my very honest opinion, I think certain markets in Australia will do much better than others in the coming years. Again, this is only my opinion, and I know that a lot of you guys won't agree with me, and that's fine. I do encourage you to do your own research and due diligence. But my current investment strategy does not involve Melbourne or Sydney, but I will instead focus on the more undervalued markets, such as Perth, Adelaide, Brisbane, and some regional markets in Victoria and New South Wales. These markets have much better rental returns, lower vacancy rates, and most importantly, these properties are more affordable to the average Australian. If you look at Melbourne or Sydney, if you want to buy a good property in a good suburb, it's going to cost well above $700,000. And with investor activity slowing down in these markets, do you think first home buyers really have the ability to keep driving up prices in these markets? I personally don't think so. But as always, this is only my personal opinion and not financial advice. I am not a financial advisor, but I will give you a very good advice, and that is to do your own research. Alright guys, that brings us to the end of the video. I want to thank all of you guys for watching till the very end. If you got value from this video, please do me a huge favor by hitting that like button, commenting your thoughts below, and sharing it with your friends. And I'll see all of you guys in the next video.